S corporation status offers small businesses a powerful way to reduce tax burdens while maintaining liability protection. This tax selection helps business owners avoid double taxation while enjoying many of the benefits of a corporate structure. An S corporation is a business entity election that determines how a company is taxed and organized. Created by Congress in 1958, this status allows qualifying small businesses to enjoy benefits like limited liability protection and single-tier taxation. When a corporation forms, it automatically starts as a C corporation, but can then elect S status if it meets specific requirements. The primary appeal of S status is that it combines the liability protection of a corporation with the tax benefits of a partnership. Unlike regular C corporations where profits are taxed twice, first at the corporate level and again when distributed to shareholders, S corporations only face taxation at the individual shareholder level. To qualify for S status, your business must meet several strict eligibility requirements. Your company must be a domestic corporation or an LLC that elects to be taxed as a corporation. You can have no more than 100 shareholders, and these shareholders must be individuals, certain trusts or estates, not partnerships or corporations. Additionally, you can only have one class of stock, though differences in voting rights are permitted. Your business must also use a permissible tax year, typically ending December 31st. The tax advantages of S corporations extend beyond avoiding double taxation. Shareholders may qualify for up to a 20% deduction on qualified business income, depending on their income thresholds. They can also increase their stock basis through retained earnings, potentially allowing for tax-free distributions in the future. One significant benefit is the potential reduction in self-employment taxes. In sole proprietorships or partnerships, owners pay self-employment taxes on all profits. With an S corporation, only the reasonable salary paid to shareholder employees is subject to employment taxes, while additional distributions may avoid these taxes. However, the IRS closely monitors this practice to ensure salaries are reasonable for the work performed. Beyond tax benefits, S corporations offer several other advantages. Shareholders enjoy limited liability protection, shielding personal assets from business debts and liabilities. The business maintains perpetual existence, continuing even if an owner dies or leaves. S corporations can sell ownership as stock, providing investment opportunities, and this stock is freely transferable. Despite these benefits, S status comes with notable disadvantages. Ownership is restricted to United States citizens and residents, with a maximum of 100 shareholders. Only individuals, certain trusts, and estates can be shareholders, no corporations or partnerships. There are formation costs and ongoing fees to maintain status. The company must be domestic, with domestic investors, and can only offer one class of stock. Perhaps the most significant risk is inadvertent termination of S status. If your business violates any IRS requirements, such as accepting an ineligible shareholder or issuing a second class of stock, your S election can be automatically revoked. This would cause your business to revert to C corporation status, leading to potential double taxation and other negative tax consequences. Forming an S corporation requires several steps. First, decide on your legal business name and reserve it with your state. Choose a registered agent to accept legal documents for your company. File articles of incorporation with your Secretary of State, complete corporate bylaws, and issue stock to initial shareholders. Apply for necessary business licenses and obtain an employer identification number from the IRS. Finally, file IRS Form 2553 to elect S status. Once formed, maintaining compliance is essential. File annual tax returns using Form 1120-S and issue K-1s to shareholders detailing their share of income, losses, and credits. Keep accurate records and observe corporate formalities, including meeting minutes and bylaws. Monitor ownership changes to ensure all shareholders remain eligible and avoid creating multiple classes of stock inadvertently. Limited liability companies can also elect S corporation status through a two-step process. First, file IRS Form 8832 to be taxed as a corporation. Then submit Form 2553 to elect S status within 75 days of formation or by March 15th of the tax year. This strategy is often used to minimize self-employment taxes, but requires the LLC to comply with all corporate formalities. S corporation status offers significant benefits for many small businesses, but it's not the right choice for everyone. The strict eligibility requirements, ownership limitations, and compliance obligations must be carefully weighed against the potential tax savings and liability protection. For businesses that qualify and can maintain compliance, S status can provide a valuable framework for growth while minimizing tax burdens.